Hello and welcome to the first module of the Carbon Cloud Academy. In this module, we will be navigating the landscape of sustainability standards. Lack of standardization in sustainability communication and reporting is a massive issue that many entities want to solve, and even more want solved. Before we dive into the nice-to-haves, let's lay on the must-haves. In the emission space, that would be the mandatory climate-related financial disclosures, also known as national climate disclosures. The not-so news is that 36 of the world's most prominent economies are making emissions disclosures mandatory. This is more than half of the global GDP. For some markets, the initiative starts with the largest companies or with companies listed in the stock exchange market. But all markets explicitly aim to scale up the initiative. So, even if your company is not affected this year, it is safe to expect that the mandate will knock on your door in the next 3 to 5 years. So let's start by putting everything in order. Here's our agenda for the masterclass on mandatory climate-related financial disclosures. In the next minutes, we will cover which markets are affected, why are climate disclosures becoming mandatory, and why now? What are the similarities among the reporting requirements from different markets? When does each mandate come into effect and for whom? What you need to disclose in each market. First of all, let's ground the information and take a look at which markets are running the mandate. Companies operating in the following markets can expect the mandate to knock on their door: Brazil, Canada, Hong Kong, EU, New Zealand, Singapore, Switzerland, UK, USA. Other markets have also announced intentions or are working on mandating emissions reporting, including China, Mexico, India, Israel, and Japan. We will revisit these markets later when there's more actionable information, but it is more than safe to assume that the reporting requirements won't differ much from the already mobilized markets. Before we dive into the requirements and timeline for each market, let's zoom out and make some sense out of the mandates. When a market mobilizes, you can rest assured that it goes beyond doing the right thing. The reason why half of the world's GDP is making this mandatory is because emissions are perceived as a serious financial risk. According to the Financial Stability Board, an organization's stance on climate change is critical viability information for investors, which translates to investors are factoring in how robust a company's climate strategy and roadmap are to tell a risky investment from a safe one. You may ask, if the market has already mobilized, why do governments on a national level need to mandate this? Well, that's because two issues with emissions reporting have emerged, and both are in dire need of central regulation. First of all, the national mandates are in place to ensure standardization of carbon accounting. The issue of comparability, or lack thereof, in emissions data and scopes has been long present in corporate sustainability reporting settings. What is included in the report, what isn't, and why gives investors heaps of information about an organization's maturity on managing climate risks. Governments have decided to regulate this and consolidate the reports on a national and even global level. Which brings us to the second issue. Nations are accountable to the climate targets they have signed with the Paris Agreement. Without the involvement of the industry, these targets will never be reached on a national level, which is why it is within the government's material interest to hold the industry accountable too. As the European Parliament very clearly states in the Mandate Directive, better data from companies about the sustainability risks they are exposed to and their own impact is essential for the successful implementation of the European Green Deal. Every food company we have spoken to, and on a general level, the entire industry, has reacted positively to the news of climate-related financial disclosures. So far, it's perceived as good news, a step closer to standardizing sustainability reporting, a chronic headache for CSR departments worldwide. The better news is that climate-related financial disclosures, regardless of the country, market, content, time, or effect, have something in common. They are all based on the same foundational framework. The content of the framework of the disclosures is all based on the recommendations on climate-related financial disclosures by the TCFD, the Task Force on Climate-Related Financial Disclosures, which sounds like a fitting name. TCFD was created to streamline emissions disclosures by the Financial Stability Board, or FSB. FSB is a G20 endorsed body that identifies financial vulnerabilities. Naturally, climate change was one of them, and the FSB concluded that companies should disclose climate change risks to ensure financial stability with transparent disclosures that support investor decisions. Now let's take a look at the content of the TCFD framework. If I could have your attention for the next 10 minutes, because your final disclosure report will look like this, give or take, depending on the market. Important to know, if you are disclosing your emissions voluntarily, like CDP for example, you are probably already familiar with the structure of TCFD. All right, let's get cracking. The framework calls companies to focus on 4 key areas: governance, strategy, risk management, metrics, and targets. The overarching matrix in all 4 is climate-related risks and opportunities. Let's drill down in each of them. In the governance section, your company is called to list and explain the board oversight on climate-related risks and opportunities, or in which ways is the absolute highest level of management involved in climate change, and management's involvement in assessing and managing climate change, or the process in all levels of management in your company of identifying operation-specific risks, opportunities, and how they are solving them. An example of the section can look like this. The second key area is strategy. This is where you lay out the problem identification of climate change as it relates to your company specifically. In this section, you will be asked to disclose short, medium, and long-term risks and opportunities, the impact of the identified risks and opportunities on your business, future strategy, and budget, as well as a scenario-based resilience analysis. And note on this one, some markets require that, but not all. Here's an example of how parts of this section may look. And this is where the big thinking and vision ends. The third key area is what you're doing about it, risk management. Here you will need to disclose your full-on process for identifying climate risks and opportunities, how you manage both, and how your identification and management is integrated in your overall financial risk management. You may need your CFO's buy-in to nail this section, so better get them invested early, because you will also need them involved in the fourth and final key area, metrics and targets. This is the part where you basically show investors that you really have your stuff together. Everything before this part would be just words. This key area applies to all markets, with one potential tweak we will cover later on. Here are the metrics you need to disclose. Climate KPIs for risks and opportunities, and they need to align with your Section 2 strategy. Quantified emissions for Scope 1, 2, and sometimes 3, put a pin on that. Targets against risks and opportunities management, also in line with your Section 2. Performance against those targets. Now let's take the pin off. In all markets, companies need to disclose Scope 1 and 2 emissions. That is, direct emissions from their operations and emissions from the company's energy use. For Scope 3, value chain emissions, most markets still require it, but give some buffer time. For example, the first couple of years you may need to only disclose Scope 1 and 2 and add Scope 3 the year after. Some markets do not require it at all, and in others, including them is still a discussion. We will cover what applies to your market when we drill down on each individually. And that's the entire content of your climate-related financial disclosures. Let's do an action-oriented recap in normal language that will actually stay with you. When it is your time to fill in your report, your company will need to have answers to these questions. What financial risks does climate change impose on our company? What financial opportunities on climate change can your company leverage? What risks does our company impose on climate change? How does your company assess these risks? What are your climate KPIs? What are you doing about the risks now and in the future? How you're doing it? How is top management involved? If you have these answers on a company level, the report will write itself. Or the job of someone from your finance department will become much better and much easier. Give yourselves a pat on the back. We cover what the mandatory climate-related financial disclosures have in common. Now let's dive in to the specific requirements and timeline for each market, starting with the Great White North, Canada. The mandate affects at first stage financial institutions, banks, and insurance companies, and comes in effect in 2024. Companies need only disclose climate-related risks and quantified emissions, but may omit climate-related opportunities. However, the report must cover the same content for the reporter's clients as well. However, the bill clearly communicates its intentions to broaden the spectrum of reporters and also budgets 8 million Canadian dollars for the ISSB and its new office in Montreal. Moving on east, our next market is Hong Kong. The mandate in Hong Kong comes from the stock exchange and applies to all 2,500 listed companies from 2025. Hong Kong accompanies the mandate legislation with comprehensive and helpful guidance on how to report and requests the following: stated accountability and knowledge from the board and management on climate-related issues. An additional classification of risks into physical or transitional, whether it's a risk to your company from natural outcomes from climate change or financial outcomes. A thorough scenario-based analysis. Remember, the part we said was included in some markets and not others? Hong Kong requests the most thorough of them, all with scope and boundaries clearly stated. A risk prioritization based on a combination of likelihood, impact, adaptability, and recovery. Metrics that comply with the following criteria: decision useful, understandable, verifiable, objective, and comparable. And targets related to a baseline and with a time horizon. So it's a lot, but it's concrete guidance. Staying in Asia, our next market is mighty Singapore. The mandate is also issued by Singapore Exchange, the stock market, and starting with the financial year 2023, it applies to listed companies within 3 industries: finance, agriculture, food and forest products, and energy. The Singaporean disclosures follow, as usual, the TCFD framework with 3 clarifications. Reporters need to disclose the level of assurance, motivate their data quality and completeness, and finally, directors or managers in Singapore must undergo sustainability training. If you keep up with Carbon Cloud's Academy's future modules, the climate aspect should have you covered. Moving on to Europe and its biggest part in particular, the 27 nations of the European Union. The EU is notoriously slow, but also notoriously thorough. Here's what the cards have in stock. Be prepared for a large deck. The EU extends the reporting to sustainability overall. That means environmental, economic, and social sustainability. The European Commission also pledged to adopt a harmonized set of reporting standards by June 30th, 2023, just in time for the first reporting phase. Since we're at it, let's take a look at the timeline. Mandatory sustainability disclosures in the EU will begin in 2024 and will scale up in 3 stages. The first stage begins in 2024 and applies to companies and their subsidiaries already submitting non-financial reports. This is just short of 12,000, and it covers companies listed in the stock exchange market, banks and insurance companies, companies with over 500 employees, and non-European companies with a turnover of over 150 million euros for 2023. Stage 2 continues in 2025 for fiscal year 24, and it applies to large companies and their subsidiaries not currently subjected to non-financial reports. At the final stage, the mandate continues to listed SMEs with a transitional opt-out possibility until 2028. The content of the report highlights some further specifications. Physical and transitional classification of risks, like we saw in Hong Kong. evaluation of supply chain resilience, scenario-based adaptation plans, carbon removals reported in a separate additional section, and a robust strategy to reduce absolute emissions in all scopes. The bill also provides guidance and a timeline for the level of assurance. It acknowledges the challenge that commits to publishing reasonable assurance guidance by 2028, when the mandate is in full scope. Until then, limited assurance is possible, but you are required to obtain it from independent external auditors. Particularly for climate, companies have relatively less freedom to set their own targets. Reporters need to explain their business plan for transition to carbon neutrality by 2050. They also need to disclose absolute emissions reductions targets for both 2030 and 2050, motivate the targets scientifically, and annually report progress. As a cherry on top, the bill is also asking for value chain or Scope 3 targets and reduction plans. Keep in mind this is optional for the first 3 years of reporting, but you would need to motivate the omission and share your plans on obtaining information. All right, that was a lot. Let's jump to some short and sweet markets to take a breather. Switzerland. Disclosures in Switzerland are an easy one as they mostly follow the EU's requirements. Publicly listed companies with over 500 employees earn over 20 million Swiss francs in assets or 40 million francs in turnover must start reporting in 2024 for 2023. The most interesting part of the Swiss mandate is that it is one of the few that has explicitly shared sanctions for non-reporters. Companies that fail to comply may be issued a fine of 100,000 francs. The content of the report is heavily relying on the EU model and the conclusions pending there on level of assurance and reporting standardization. Another short and sweet market is Brazil. Brazil has actually moved quite early in the space of climate-related financial disclosures, as segments 1 to 4 of regulated financial institutions, that's banks, have already been disclosing since 2021. The first phase included only the governance strategy and risk management part, and the second phase that rolled out in December 2022 included emissions metrics and targets. As of now, other industries are not immediately affected, unless of course their investors fall within segment 1 and 4, in which case they may need to indirectly disclose some information. Last but not least of the speed round is New Zealand. The mandate affects large publicly listed companies, insurers, banks, and investment managers from this year, 2023. The reporters are still quite localized, but other industries may be indirectly affected via investment managers who need to disclose on a fund-to-fund basis. Independent assurance on emissions metrics will be introduced at a later stage. From one island to the other, it's the UK's turn. The UK is already hard at work with climate-related disclosures, with public companies, banks, insurance companies, and private companies with a turnover of £500 million and over 500 employees mandated to report pretty much as we speak for fiscal year 2022. However, the UK has probably the most ambitious rollout plan, as the mandate is expected to come into effect across the economy in 2025. When it comes to the content of the report, the UK has a rather extensive clarification sheet, but at the same time offers really comprehensive guidelines. Climate-related financial disclosures are part of the existing strategic report and follow the TCFD guidelines with the following specifications. Filers must disclose how risks and opportunities are, brace yourself, identified, assessed, managed, and integrated into the company's overall risk management, and how they are related to the company's operations, specifying the time period and impact. Filers also need to ensure that their disclosed targets are related to the identified risks and opportunities, disclose which KPIs and metrics they use to track progress against those targets, and explain how their metrics are calculated. Let's stay on the metrics for a second. The legislation demands an emissions data gap analysis, and the company's plans to close it. In the meantime, any gaps or incomplete data may be filled with modeling. Goes without saying, of course, data must be disclosed in carbon dioxide equivalents and in terms of intensity. That's not all. The report must also include a scenario-based resilience analysis. All this includes, at this stage, Scope 1, 2, and 3 being optional for the first year only. Quite thorough in it. I got some good news for you. This is the last market, and it goes a bit like this. Oh, say, can you see the climate-related financial disclosures? Sorry about that. Let's close our first module with the USA. The American proposal is rolled out in phases. The first phase comes in effect in 2024 for the financial year 2023, and it starts with large accelerated filers, who are companies with an aggregate worldwide public float of $700 million and more. If you're one of those, you know it. The second phase follows a year after, 2025, for fiscal year 2024, for accelerated and non-accelerated filers. Those are A. Companies with a public float of $75 million or more, but less than $250 million in annual revenue, or B. Companies with a public float of more than $250 million, but less than $100 million in annual revenue. Non-accelerated filers are simply companies that are neither small, large, nor accelerated filers. The third and final phase begins in 26 for 25 and affects smaller reporting companies, which are companies with public float of less than $250 million, with annual revenue of less than $100 million, and either no public float or a public float of less than $700 million. If you have placed your company in the right phase, let's move on to the content of the disclosures. No surprises there. Following the TCFD and GHG protocol guidelines, the American bill is at this stage quite thorough on the metrics. Filers must report greenhouse gas emissions on Scope 1 and 2, as well as Scope 3 if the company already has Scope 3 targets or if Scope 3 is material. Determining what is material can send anyone's head spinning. So to clear things up, if your company manages food, Scope 3 is material. Emissions must be disclosed both in absolute terms and in terms of intensity, per unit of revenue in dollars, as well as per unit of product, with the accompanying methodology, data sources, and assumptions, and the breakdown per greenhouse gas. Strategy, governance, and risk management include specifications we have seen in other markets too, such as board and management expertise and responsibilities, related processes, risk assessment in 4 levels: physical, regulatory, technological, and reputational, and how they affect the business model. Companies must also disclose targets and transition plans. All good here, but the specifications call for some extra attention. Point 1, offsets. If offsets are a company's primary reduction strategy, the company is classified as high risk. The use and quality of offsets must be outlined in detail, and any discrepancies must be included in the risk assessment. Point 2, renewable credits must be disclosed in detail. Point 3, the company also needs to report on low carbon product revenue. This means that companies need to have low carbon products in their portfolios and the related revenue from them. And finally, point 4, companies should also disclose the potential of an internal carbon price. If this is something your company does, be prepared to disclose the measurement boundaries for carbon dioxide equivalents, the price, how the price will change over time, as well as the rationale. You want to hear something great? That is the end of the mandatory climate-related financial disclosures. You've made it to the end of the first module. I hope you now have a better understanding of what's coming and it's not panic-inducing anymore. All in all, if your company has been working with your emissions systematically, you should be in a great place. If anything, this mandate is an advantage for the early movers. The reporting premise in all markets we covered is not normative on your overall strategy, and the goal is to highlight the companies that are climate forward as a safe investment and a resilient organization. You can always download the slide deck to read through the consolidation of disclosure in texts, and if you have any questions, don't hesitate to ask away at hello@carboncloud.com. Coming up next is Emerging Climate Standards, an overview and sense-making sessions of all the abbreviations you hear thrown around and what they actually mean for your company. See you then.